Three quality stocks trading at fair value. This is what this video is about. I'm gonna share with you three stocks that I believe are good companies, quality companies trading at fair value, could provide 14 to 15% annual return or a double every 5 years. As you guys know from my videos, this is the minimum that I look for. And I do own one of those stocks, which a lot of you are familiar with. I'm gonna give you a quick update. I'm gonna talk the rest of them. The last one's gonna shock a lot of you because it's an amazing company, but I labeled it as a risky stock. I'm gonna go from the safest stock to the riskiest stock, and I think it's gonna shock all of you. So I really hope you enjoy this one. But before I get into it, I just wanna give a quick comment, a very quick comment on my last video, and it's called my two buy and hold forever stocks with massive upside. And this one, it really surprised me because I got a lot of hate on it. And I thought you guys would really like it because I'm talking about two stocks that you're never going to find on YouTube. You're never going to find on Seeking Alpha or Motley Fools and all these kind of websites. These are stocks that could deliver 20 to 30% that I personally own. You know, they're very risky, of course, but a lot of them have backlogs. They're just pretty good companies and stocks that I own. But it's just maybe surprised a lot of you because they were trading at 52-week highs and because they weren't like well-known companies like McDonald's and Pepsi and other things. And my main goal in the market is to make around 20% a year minimum. Like that's what I try to shoot for. Over the last 3 years, I was able to exceed that. This year, for example, I am up 51%. Last year, I was up 28%, not the best. 2022 was a good year for me. I was up 27%. All of it is on YouTube. Every single year, I have, videos reviewing all my trades and all that stuff. All of them are documented. You could find all of that stuff. And the main reason I achieve it, or the main way I achieve it, is by buying, safe stocks that a lot of you know, maybe McDonald's, Pepsi, and other ones that could deliver 15% a year. And then I speculate on some micro caps, which have high insider ownership and all these things, that could deliver 20, 30, 35% a year. And that's how I get my minimum of 20%. And I was able to sometimes exceed it. For example, I own a micro cap I talked about before. It's called Mama's Creations. They just make meatballs. It's a food company. I bought it at $1.74 last year. Now it's up 333%. For me, I think it's up like 342%. And I talked about it on YouTube at $3 per share. And people, again, hated it because it was trading at 52-week high and it wasn't well known. But this is my strategy. And I just wanted to explain the point so a lot of you don't get surprised why I talk about some small stocks instead of only quality companies, because my goal is to get a minimum of 20%. And for me to get such returns, I can't really do it, buying Pepsi and holding it forever. But this is just from my own thing. Now, the first stock that I own, and I talked about it many times, and I still believe it's trading at fair value, and this stock is Visa. Visa is down around 8% from a 52-week high. It was down as much as like 12 or 13%. And I did buy the dip on Visa on August 5th on Monday. It was a good day for me. I did a lot of buys on Visa and many different stocks. But Visa for me is a pretty decent company. And now it's hard to find, kind of quality stocks trading at fair value. The best time to buy them was around August 5th, August 6th, a week or 2 weeks ago. Now it's really hard. And being honest, it's not really the best time to be buying quality. I think it's just time to be buying other stuff, but I'm going to discuss them more in a different one. But Visa has a pretty good earnings report, around 10% revenue growth in total, not bad at all. And the main argument around Visa is that it's a huge company, like $500 billion, and it can't keep growing forever. And this is a valid argument. But I heard it on Visa when it was trading around 150 billion. People said it's a big company. It cannot keep growing forever. I heard the same thing around Microsoft when it was trading like 200 or 300 billion, that it's just too big. It's not going to grow. There's no upside. There's none of that stuff. But these quality companies with such moats, they always surprise us. They always surprise us to the upside. They always manage to pull it off. And Visa has something pretty bright within its portfolio, and it's called other revenues. And other revenues was up 31%, much faster than services at 8% and 9%. Although 9 and 10% for a $500 billion company is amazing. But they have the other revenues which are rapidly growing, and they're growing a lot, and they grew 31%, and that's pretty amazing for Visa. If you look at where the stock is trading at, it's trading around 24 times earnings. And if I look at 24 times earnings, you look at this line that I'm showing you, just looking at this line alone, it has historically been a good time to be buying Visa stock around 23, 24 times earnings. The lowest the stock has traded at was 20 times earnings or 20 and a half, and that was mainly in March 2020. Now you're buying it at 24 times earnings. This is a company that's still growing revenues 10%. This is a company with 56% net income margin. 56%. Most companies will never get anywhere close to 56%. It's higher than Google, higher than Apple. I think it's also higher than Microsoft. I mean, 56%, guys, is absolutely insane, and little to no stock-based compensation. Amazing stuff. The company is still putting up very good earnings per share growth, around 16% for this year, and for the future, it's around 12 to 13% of earnings per share growth, which I personally believe is fair, especially with other revenues, growing. And to me personally, the way I look at it, I'm paying 24 times earnings for a company without that much stock-based compensation, with a massive moat, and 56% net income margin, is still growing 12 to 13% at earnings per share, and they're paying a dividends. They have the free cash flows. They keep buying back stock, doing dividends. It's all inflation index. If prices go up 10%, Visa is gonna collect 10% more. The fee is still the same, but the ticket items make up for it. So it's all like inflation adjusted. And I'm getting all those things. For me personally, relative to other opportunities at 4 times earnings on a historical basis, Visa makes a lot of sense. And I think Visa is a buy, and I think Visa will likely deliver a return pretty close to its earnings per share growth of 12 to 13%, plus you have a little dividends. So I say it's by 13, 14% annual return. I think is very realistic on Visa. This is excluding, the potential of more growth in the future, and this is excluding some kind of a multiple expansion, which I believe the bottom here on the multiple is pretty close to being in, and sometimes you have multiple expansions to 26, 27 times earnings, and this would only add to the 14% annual return. So 14% annual return, this is like, almost like 90, 92% on the upside over the next 5 years with a quality safe stock like Visa with a wide moat. It makes Visa stock a buy for me, especially relative to other opportunities again, and I own the stock and I like it very much. The second stock, which I always wanted to buy, and every time I come to buy it, I find it better opportunity, mainly within my small caps. That's kind of my favorite ones. And every time I'm like, I'm gonna buy it now. Then I just find another stock and I end up skipping it, and the stock has gone nowhere. And this stock is called CP, Canadian Pacific Kansas City. They recently merged like a year or 2 years ago, and the stock has been flat since 2021. And every time I make a post on Twitter about CP, a lot of loyal shareholders, they love the company, but they're frustrated that the stock isn't going anywhere. Like, when is the stock gonna move? When is it gonna break out of this miserable cycle? And the truth is that CP was extremely overvalued before, and in my opinion, it's getting very close to fairly valued for the growth and for everything else. I'm going to explain it now. But if you're not familiar with CP, CP has an amazing, you could say, railroad network. They connect 3 countries within one network, and I believe it's the only railroad companies that actually has such a network, and it's mainly from Canada to the United States to Mexico. This is pretty amazing. If you're like me and you're betting more on reshoring, if you're betting on deglobalization, if you're betting on more nearby trade from something like Mexico versus China, then CP could be an amazing way to bet on anything locally in terms of reshoring after COVID, lockdowns and all that stuff, infrastructure and all those things. CP will benefit from all of it. And if you look at the US share of total imports, where the US is importing stuff from, Mexico has surpassed China for the first time ever. And now Mexico is our largest trading partner. And this trend is only continuing. And we have a lot of tensions. The world is splitting in half. And this is an amazing way to bet on it. If you believe in that stuff, I personally believe in it. I have a lot of infrastructure stocks, United States and Canada. I have a lot of energy stocks for data centers. I have a lot of stuff betting on this scenario. And if you're like me, you believe in it. You believe that Mexico's imports is going to increase and China is going to decrease in the future. This is an amazing way to bet on it. CP is an amazing way to bet on it. It's pretty good, and I think it's going to continue. So last earnings report was very good. Revenues were up over 14%, which is not normal for a railroad company. Core adjusted EPS, which is key because it takes in all the merger and one-time expenses and really tells you the core of the business, how fast it's growing. And it grew 27%. And that's very good for the company. If you look at the multiple is really getting much better valued. And it's now trading at 23 times earnings. The mean was 22 times. It traded as high as 28 times, which was insane. And now it's trading around 23 times earnings. And 23 times earnings, a lot of people would say that this is extremely expensive, especially if you compare it to other railroad. CP is trading at 23 times. You have CNI, Canadian National Railway, I believe it's called, and it's trading at 19 times. Then you have Norfolk Southern, it's trading at 18.7 times. And CP is trading at a much, much higher multiple. But in my opinion, CP does warrant a higher multiple than CNI and NSC because CP first has a little bit higher net income margins, around 30 to 31%, versus something like NSC at 24 and 26%. This is a pretty big difference in margins, but CP also has much faster earnings per share growth than a lot of the other players, and this is what makes this merger very special. They have a long-term outlook from 2024 to 2028, which I really love whenever companies give a 5-year outlook or a 4-year outlook. It gives us a lot of insights of what kind of returns we can expect from the stock. And they are shooting for high single-digit revenue growth and double-digit core adjusted combined EPS, which takes into account merger and everything, return to double-digit core adjusted combined return on invested capital. At least they pay attention to it, distribute, I believe, 99% or 90% in terms of free cash flow conversion. And most of the railroads, they normally, after CapEx, do buybacks and dividends. They return value to shareholders. But they're expecting double-digit core adjusted earnings per share growth. And the analysts, they have it between 11% to 15%, 14%, 19%. So on average, I would say 14 to 15%. So for me personally, if CP does not experience a multiple contraction, I would say the return is likely going to be somewhere pretty close to the earnings per share growth. And I'm not using any spreadsheets. I don't even use spreadsheets that much, to be honest. I just use them to highlight points. But most of my analysis is just common sense analysis. I don't really believe in all those sheets and all that stuff. Just common sense stuff. But looking at CP at 23 times earnings or 23.4 times, there could be some room for downside. So I could see some kind of a multiple contraction. If I personally had to buy CP and I'm looking for a 15%, 14, 15% annual return, I would try to shoot for 22 times. 22 times, I believe that would be around, for CP in terms of US dollars, I believe that would be around $73 per share. So $73 per share, or somewhere pretty close to 22 times earnings, at least on a historical average. This has been somewhere close to a bottom on CP. So you could get around 14 to 15% annual return from the earnings per share growth from CP, and you could get a potential multiple expansion if the market gets excited about reshoring, gets excited about the whole infrastructure. You could get a multiple expansion from 22 times to 26 times. So for me personally, if you're a very long-term investor, I think CP over here is a buy. Could deliver 13, 14% annual return. But if you do buy it around 74, 73, which is 22 times earnings, you're going to have some kind of margin of safety with a railroad that's just pretty amazing, that connects all three countries together. You cannot build it, you cannot replicate it. And this is the mode of those companies. Pretty amazing stuff. I love this company. I'm going to end up buying it likely in the future. But for now, I just keep finding better opportunities. And I share everything I do in my own group. This is the link if you're interested. The last stock, which I said is the riskiest one, and this is the one I'm going to get the most comments on, and it's mainly Google. Google is down 12% from all-time high, and this should be the safest stock in the stock market, like Google, guys, like one of the safest stocks ever. You could look at this pictures that I put up on my X account, and it mainly shows the expansion of Google Chrome, how it just took all over the world except Greenland, I believe. So it's amazing, wide mode company. It should be the safest one, but it's now the riskiest one thanks to the DOJ antitrust move, antitrust lawsuit. I had a lot of comments on my last deep analysis of Google. A lot of you told me they should be maybe trying to fix inflation, fixing bread prices and things that affects a lot of people, not really be going after Google. And I kind of agree with that stuff. But this is what's happening. And they're considering breaking up Google. And this is a big deal, guys, because Google owns Android. And the whole lawsuit, which I discussed previously in this video, was mainly around Google paying Apple $20 billion to put Google search as the dominant kind of search engine on Safari on their own website. They're paying $20 billion. Now, Google will likely save $20 billion a year, and then maybe they will require Apple to give people more choices. And in this case, I believe people would still be using Google. They're not going to be using Bing or using, I don't know, like some kind of other website, Yahoo search or whatever it is. I think people will still choose Google. We're all used to Google. We all say we're going to Google this word or Google that. No one says we're going to Bing this or Bing that. I just don't think so, guys. I don't think it's going to affect it that much. But breaking up Google is a big deal because they own Android and they have Google search as a search engine for Android. Now, I'm not sure how this is going to play out if they split the companies from Android and Google search. I don't really know how it's going to play out. So a lot of people said that this is going to be extremely bullish because then Google can provide a higher multiple if it's separated rather than if it's all combined. And maybe this is true, but we don't really know the details. We don't know the regulations that's going to be imposed. We don't know the fines that Google is going to have to pay. But for me, thinking about it all, if you're a risk taker, Google over here is trading at 20 times earnings. And it's not very often you're going to get an amazing wide moat quality company like Google for 20 times earnings, which has been historically a good time to buy. The lowest it went to over the last 10 years was 16.7 times earnings, and now trading at 20.7 for a company that's still growing earnings per share 14, 15, 16, 17%. That's pretty amazing stuff. If you're willing to take the risk, I would say Google is a buy. But if you have better opportunities in the market, you don't really have to take this risk. There's plenty of them. I talked about CP, talked about Visa. They don't have the risks that Google has. And they have, in my opinion, pretty similar upside potential. Also, Google could get more of a multiple expansion. But it's mainly up to you. And no one knows how it's going to play out. But I like it over here. I like Visa. I like CP, and I explained to you my strategy a little bit of how I do within micro caps and large caps. If you're interested, again, you could join my own group and get everything I buy and sell and all those things. So thank you again for watching. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.